What's up everyone, I'm Steven and welcome back to my channel. This video is all about Charles Schwab Options Trading. Today, I'll focus on the covered call. I'm going to talk about what a covered call is, when to use the covered call strategy, and show you how to sell a covered call. Options trading can be used to generate income, and the covered call strategy is one of the best ways to generate consistent income and make you some extra cash. When you're selling covered calls, you make money on the premium that you collect. The premium is the current market price of the option contract. It is the money that you receive today for selling the contract and keep, regardless of whether the option is exercised or expires worthless. So what is a covered call? In a covered call, you collect a premium for selling someone else the right to purchase a stock that you already own at a predetermined strike price at which a put or call option can be exercised, and expiration date. To use a covered call strategy, you need to own at least 100 shares of the stock for every call contract you plan to sell, as each option refers to 100 shares of the underlying security. You can either build up your shares over time and add and buy shares here and there until you reach up to 100 shares of the stock, or you can buy 100 shares of the particular stock outright to start using this strategy. The share prices of different stocks vary drastically, so if you want to sell covered calls on a stock that costs $10, you would need an initial investment of $1,000. If you want to sell covered call on a stock with a share price of $100, you would need an initial investment of $10,000. If you pick a stock that is more volatile, meaning there is more day-to-day fluctuations in the share price, you would collect a higher premium. But your option is also more likely to be exercised depending on the strike price you set. If you pick a stock that's more stable and steady and has less fluctuation, you would collect a lower premium, but your option will be less likely to be exercised depending on the strike price you set. Finally, you want to pick a stock that you are okay with selling. Do not sell covered calls on a stock that you want to keep for the long term, because if the strike prices reach at expiration, the option will be exercised and you will sell the 100 shares. Let me know what stock you want to sell covered call on in the comments. Now I'll show you how to sell a covered call in one of two ways. For the first, go to the trade at the top of the navigation bar. Then under options, hit trading. Enter the stock ticker into the box. The example I'll use today is with Pfizer stock. I chose Pfizer stock because it is a stable, dividend-paying stock that I can collect an additional premium from for extra money. It is also a stock that I'm okay with selling because if the strike price is reached at expiration, the option will be exercised and I will sell the 100 shares. Let's choose March 19 as the expiration date for our example. It is important to pick a strike price above your cost basis, or what you paid for the stock, so you can make money even if the option is exercised. If your cost basis was $34, choose a strike price above $34, whether it is $35, $35.50, or $36. The higher the strike price, the lower the premium. We will select an expiration date of March 19th and a strike price of $36 for this example. Select action as sell to open, as you are selling an options contract, the covered call. Enter the number of contracts you are selling. We will enter 1. Enter the order type. We will select market order to execute at the market price for the premium. Now, the estimated amount is for the premium of $51 that we will pocket today for selling this contract. Hit the review order. Confirm everything is good to go on the next page. You are selling to open a market order of one contract of Pfizer with an expiration date of March 19th of 2021 at a strike price of $36 for day only. You will notice that for the options contracts, there is a 65-cent commission charge for each contract, so your total amount that you will get today will be $50.35. After everything is confirmed, hit place order, and that's it. You have sold your first covered call. For the second method, you enter the sell order through the option chain. View the option chain by going to trade at the top of the navigation bar and chains. Enter in your symbol. In this example, we will do Pfizer again. If we have all strike prices selected and choose the March 19th expiration date, you can see the premium you can collect at different strike prices here under the column bid. The nice thing about the option chain is that you see a lot of information at once. At $36 strike price, you will collect 51 cents per share, which is the $51 premium, as each option contract is equal to 100 shares of the underlying security. You will see you get a higher premium at a lower strike price and a lower premium at a higher strike price. If you click on the sell order on this screen, this will also populate your sell order, the same I showed earlier. The difference is that the order type is a limit order, meaning it will only execute at the price selected, but this can be changed to a market order. If you hit review order, you will be selling the same covered call as demonstrated earlier. You see, you are selling to open one option contract of Pfizer with an expiration of March 19th, 2021 at a strike price of $36 and will collect $50.35. After everything is confirmed, you can also hit place order. Now after you place your order by either method, here's what can happen. The first thing is that you can always collect and make the money from the premium collected. Now if by the expiration date, the share price is below the strike price, the option contract expires worthless. So you keep the 100 shares of the stock and make money from the premium collected. The second is by the expiration date, the share price could have went to or above the strike price at expiration, and the contract is exercised. You will sell the 100 shares to the buyer, you will make the difference between the strike price and your cost basis and the money from the premium collected. If the share price was above the strike price, you miss out on the potential gains from that difference. Another way to start off the strategy, or if you want to continue the strategy if your option was exercised, is to sell cash secured puts. You can collect premiums from selling a cash secured put on the stock that you want to buy back into. I plan to make a video on the cash secured put strategy in the future. Hope you guys enjoyed and found this video helpful. If you did, go ahead and hit that like button and hit that subscribe button. Hit the notification bell for more videos delivered to you. If you have any other questions or comments, feel free to leave them down below, and you guys have a great one.